Okay, so off we go in our exam review for chapters 4 through 6. So, chapter 4, planning your tax strategy, we're looking at starting with taxes and financial planning associated with it. There are common goals, and if you will, related to tax planning. They include such things as knowing the current tax laws, of course, maintaining complete records, making financial decisions, if you will, that help reduce your tax liability. Um, what we mean by that is that we want to, how do I want to put it? It's all about tax avoidance, meaning avoiding taxes, paying your fair share of taxes, etc. But at the same time, not paying more than your fair share, but not evading taxes. Avoiding taxes is completely legal and perfectly fine. Evading taxes is breaking the law, and that's what we do not want to do. Anyway, to start with, and the underlying purpose for taxes, of course, is to fund government. So uh, it goes back to your income. Income, it can be broken down into three categories. Income can be broken down into consumption, consumer spending, taxes, funding government, and saving, what you set aside, what you forego. So again, the idea behind taxes is to finance government activities um, that presumably will benefit us or benefit society as a whole. At any rate, the different types of taxes, taxes on purchases, uh, which would of course be state and local taxes and also federal taxes and on purchases. State local taxes would be sales taxes, generally speaking. Um, and on federal taxes, they're typically excise taxes, such as taxes on gasoline at both the state and the federal level, um, taxes on cigarettes, alcoholic beverages, tires, air travel, telephone service. That's another biggie. If you look at your cell phone bill, you'll see plenty of taxes levied coming from both the state and the federal um, taxing jurisdictions. Okay. Next, we're looking at taxes on property. Property taxes would include such things as on your home, real estate property taxes, and also personal property taxes, which would include registration fees and taxes on such things as boats and so on and so forth. At any rate, so those are taxes on property, taxes on wealth. That would be taxes on estates when people die, their estate is taxed, and depending upon how much you're passing on to your descendants, if you will, taxes would be based upon again on that estate, on the monies that are being passed on to your descendants. Um, yeah, that would be again, it would be called an inheritance tax. At any rate, there are limitations on that and also different levels, but at any rate, those are taxes on wealth, taxes on earnings, or income taxes, if you will. They would be such things. The general, the so far as income for your labor is concerned, those are generally called withholding taxes or payroll taxes, rather. A payroll tax would include such things as Social Security taxes, Medicare taxes, withholding taxes, meaning estimating how much taxes would be assigned to that amount of income that you're earning at a given time. And you'll see those on your paychecks, the withholding taxes that would be included in that. Okay. So, for example, uh, so far as like taxes are concerned, um, uh, you're at the taxes on your earnings turning, it wouldn't just be on taxes on, your labor for your, included in your paycheck, would also include such things as taxes on interest, any interest that's earned over a period of time, and so on and so forth. At any rate, so when we go back to moving on to the income tax fundamentals, we're looking at the process of determining your federal income tax. Involves tables where you compute your income, calculate the amount of taxes you owe, and compare this amount with the income tax payment withheld. Remember back to what we said about the payroll taxes and withholding taxes, how much was set aside during the year, and from that you determine how much you actually owe. So how much you owe, how much you set aside, less how much you owe, and if you have anything left over, that would be a refund, and if you're short, that would be the amount of taxes that you owe, net taxes that you would owe at the end of the year. So, at any rate, if when we're going through the steps on this, if you will, the first step we would be talking about is when we're trying to determining the adjusted gross income. And that's the taxable income. Okay, the taxable income is the net amount of income after allowable deductions, exemptions, and so on and so forth that are after that's all computed. That gets us down to our adjusted gross income. So earned income is then money that's received by an individual for personal effort, again, in compensation for in terms of wages, salary, commissions, fees, tips, bonuses, etc. Investment income, also called portfolio income, is money received in the form of dividends or interest. And passive income, then, moving on, would be which you're not actively participating in, such as a limited partnership, where you have you're part owner in a company and you have nothing to do with the day-to-day operations. You're just receiving compensation, if you will, for your investment. That would be a passive partnership or passive income associated with that limited partnership. An exclusion is the amount that it's taken out or not included in gross income, such as foreign income when working in another country, because the exclusion is set up because you are not, since you're paying taxes in another tax jurisdiction, you're not liable for taxes in your home country, or in the U.S. in this case. Tax-exempt income is income not associated with, or not subject to tax. Tax-deferred income refers to the income that will be taxed at a later date. These are IRA, 401k savings that are set aside pre-tax. Okay. Adjusted gross income, then again, is gross income after these certain reductions have been made. So step 2, computing the taxable income. So a deduction is an amount subtracted from the adjusted gross income to arrive at that taxable income. So for every taxpayer receives at least a standard deduction, a set amount on which no tax is paid. Many individuals qualify for more than just the standard deduction. Itemized deductions then are expenses that a taxpayer is allowed to deduct from adjusted gross income. And it has to reach a certain level, but they would include such things as like medical, dental expenses, certain state and local taxes. It's called, anyways, it's SALT, so state and local taxes. Certain interest payments such as home mortgages, contributions, donations to charitable causes, casualty and theft losses, moving expenses, and some other certain job-related miscellaneous expenses. Say, for example, if you have an office in your home, these are all deductible. These are all things that reduce your tax liability, is what it boils down to. So when we talk about the difference, if you will, between deductions and exemptions. Exemptions are is a deduction. It's a deduction for yourself and your spouse and qualified dependents, and what that means is it's a set aside based upon the individual, the spouse, or other qualified dependents. Anyway, so moving on to the calculated taxes. This is step 3. The taxable income is the basis for the amount of income tax that you're going to pay, that you're liable for. The use of tax rates and benefits of tax credits are the final phase of this tax computational process. So using your taxable income in conjunction with the appropriate tax table or tax schedule, let me rephrase it. So you want to look at your taxable income, and you would, to determine what your tax rate is going to be, you look at that in relation to the tax tables that are there or the tax schedules, and oftentimes these are calculated for you if you have a TurboTax program, etc. So the marginal tax rate, what that is refers to is rate of tax calculated on your last or next dollar. In economics, the term marginal means next, the next item, whatever it is that you're talking, whatever you're going to be measuring, it's going to be whatever is on the next dollar that you earn, for example. That's where your marginal tax rate comes into play. So meaning, in kind of short form, is that say you earn $50,000. For the first 25,000, half of that income, you're paying a 15% income tax, and for the next $25,000, you're paying a 20% income tax. So the margin means that amount of income that you're earning and how much you're being taxed for that marginal, that measurable income, if you will. So each tax rate includes a bracket or a range of income levels, as I just described, to calculate those taxes. The average tax rate is the total tax divided by your total taxable income, period. A tax credit then is an amount subtracted directly from the amount of tax you owe. So this is why when we're talking about tax credits, that's the way to go. That's what you want. You want to have tax credits more so than tax deductions, because deductions just refer to the rate of tax that you're paying for that amount of income. So if you're deducting $1,000, that reduces at whatever, if you're in the 25% tax rate. So if you've that would just mean that for every 20, you would be reducing your taxes by 25 cents on every dollar that you're earning, rather than a tax credit of $1 would be reducing your entire tax, your entire tax liability, if you will, by that whole dollar. Anyway, tax credits are the way to go. So making tax payments. Now with there's a pay-as-you-go system, which started in, I didn't realize this, but it started in World War II in the 1942, 1943, and it requires employers to deduct an amount for federal income tax from your pay. So you've got to do this on an ongoing basis. So if you earn income, you have to have taxes withheld. Those are withholding taxes, if you will. This withholding amount is based on the number of exemptions and expected deductions, so you're making your estimates, right? The W-2 form that you receive at the end of the year shows your annual earnings and the amounts deducted for your federal income taxes throughout the year, Social Security, and also in the case in Michigan, there are state income taxes, right? So that's all that would be recorded in your W-2 form. So students and other low income may file exemptions from withholding if they pay no federal income tax from last year. So a lot of this is historically based, and there is some leeway, but you definitely have to keep an eye on this, and you don't want to overdo this, because if you reach a point where you're owing too much in taxes, then you may end up getting a penalty with that too, maybe penalized. So you try to keep up on these things and do your best, make your best efforts so far as estimating what your income is going to be in the upcoming year. So people with income also from savings, investments, and like independent contracting, where they get a 1099 form rather than a W-2, royalties and lump sums. These are all things that are recorded out there, if you will. So payments from pensions and retirement plans may be required to make estimated tax payments again during the year. So if you're going to be withdrawing from your IRA, if you're retired, then you have to pay the taxes as you go for that given quarter. So deadlines and penalties, most people are required to file their income taxes by April 15 for the federal, and I think it's typically April 30th for the state, but at any rate, there are deadlines, and if you fail to pay your taxes on time, of course, penalties will be attached, if you will. So onward, filing your federal income tax return itself. So the question is, who must file? So every citizen or resident of the U.S. and every U.S. citizen who is a resident of Puerto Rico is required to file a federal income tax return if his or her income is above a certain amount. The five filing status categories would be single, married, filing joint returns, so the couple filing together, married filing separate return, head of household, that would be a case of like a single parent or a guardian over someone else, some other dependents within the household. So you would be counted as the head of the house, head of household, a qualified widow or widower. So which tax forms would you use? It's things have become in many ways much simpler, which is a good thing with tax reform in 2017, and who knows where things will go from here. They seem to change every year or every few years at any rate. But typically the EZ form is used if your income is less than $100,000 a year, and if you're not itemizing deductions, itemizing meaning if you're not taking off or recognizing such expenses again, such as like medical expenses and so on and so forth, if they do not reach that certain point of your standard deduction, then that's something that it's actually very, very, very straightforward. So the EZ form is typically good enough for most people. There are also the 1040 or the 1040A form, I guess it would be. 1040, that is where we consider such things as taking into account again dependent care expenses, deductions for IRAs and individual retirement account contributions, and there is also the straight 1040, which is that's where you have itemized deductions. So it's a little bit longer, a little more involved, and if you happen to make a mistake on your tax return and you have to make an adjustment, it's called an amendment. If you file an amended return, that would be called a 1040X. These are just forms that are issued by the IRS that have to be followed when you file taxes. So completing your federal income tax return itself, major sections again for the 1040 are filing status and exemptions, income, adjustments to income, your tax computation itself, the tax credits, other taxes, the payments that would also be included, and ultimately what it comes down to is the amount that you're actually refunded or the amount that you owe, and you have to sign off on it, of course, at the end, attesting to you're taking your best shot at this and being truthful in filing your taxes. So filing state income taxes or state taxes, state of Michigan, for example, there are taxes, there's a state tax, it's about a 4% tax rate overall. And there are several states that don't have state taxes, like I think Nevada, Florida, Texas, I think they do not have state taxes, if you will. Onward. So when we're talking about tax assistance and the audit process, it's a scary word, audit, but we'll walk through it very quickly. The IRS, the Internal Revenue Service, assists taxpayers through all kinds of online materials, and there are numbers that you can call, and this is why it's important to start as early as you can, because the closer you get to the tax deadlines, the April 15, for example, the busier it becomes and the more problematic, the more difficult it is that you're actually able to find people. There are other tax guides available through a variety of organizations, Kiplinger's, and lots and lots of stuff online that's available. Tax preparation software, spreadsheet programs. This is your own due diligence, where you set up a spreadsheet program, Excel spreadsheets, tracking your expenses through the year and kind of compiling your tax records so that you're not jammed in at the end of the year trying to figure out how to do these. When I say the end of the year, meaning, again, April 15. So there are specialized tax programs such as like TurboTax. That's what I typically use. You can always, there are always tax services, accountants, tax experts, attorneys, etc. Typically, you can do these on your own, but sometimes things get a bit complicated, and even with that, they're not terribly expensive if you have somebody just to do your taxes personally. Okay, just thought. These are just the thoughts. And so when you're planning to use a tax preparation service, consider you have to make sure that you consider how involved your tax preparer actually is, and you just have to be you have to really be careful and make sure you're going through a reputable firm, reputable CPA, certified public accountant, etc. Okay. So what happens if your return is actually audited? So the IRS, the Internal Revenue Service, reviews your returns and makes sure they are properly completed. If you have an error, your tax is automatically refigured, and you receive a bill or a refund. And what happens then is that you either pay it or you get extra, and this can be done automatically. It happens quite frequently. And if there are problems where the IRS, there's a red flag that goes up, there are different types of audits that are associated with that. And they actually audit, the IRS audits very, very few tax returns, so long as you are paying attention and behaving and not trying to go overboard with things, and just being straightforward and honest as you can. So long as you have backup documentation, you will be okay. So the types of audits would be correspondence audits to clarify or document minor questions, an office audit in which you must visit an IRS office to clarify some aspect of your return, and then there's a field audit where an IRS agent actually comes to your home or place of business, knock on your door, right? So when you receive that audit notice, you have the right to have more time to prepare. Also, you can ask the IRS for clarifications of what is being considered, and it might also be helpful to to bring your tax preparer along with you, accountant, lawyer, whatever. Be on time, of course, for your appointment, and bring all of your relevant documents with you, and be prepared to answer questions and be as straightforward as you possibly can. And keep don't go beyond the scope of what the audit is actually there for, the questions that they ask. Answer the questions, and try not to go, or don't go overboard. Just be straightforward and answer the questions, right? So onward, tax planning strategies. So the IRS reviews all returns to make sure that they have been properly completed. Oops, I'm sorry. So tax avoidance, we're on to tax planning strategies now. Tax avoidance, again, is legitimate methods to reduce one. So back to what I was saying before, avoidance versus evasion. Avoidance is avoiding paying more than your fair share, whereas evasion is breaking the law, and we do not want that. So just a few bullet points when we're talking about consumer purchases and so on and so forth. Owning a home is one of the best tax shelters available to most individuals. Real estate property taxes and mortgage interest are deductible as itemized deductions. Okay, so this is building up your pile of itemized deductions in order to do what? To reduce your tax liability. Interest on home equity loans is also deductible, and when these loans are used to buy a car, consolidate credit card debts, or finance other personal expenses. So keep that in mind. It's you're borrowing from yourself in essence, and you're able to write off the interest that's associated with that. So a variety of work expenses such as union dues, travel, education costs, business tools, and oftentimes, again, office, home office space, and so on and so forth that you can actually deduct. FSA or flexible spending accounts or health savings accounts, expense reimbursement accounts reduce your taxable income when paying for medical expenses or child care cost. And oftentimes these are pre-tax dollars that you're spending. So at any rate, workers are also allowed to put pre-tax dollars into these employee-sponsored programs. These deposits result in lower taxable income, and then the funds in the FSA may be used for paying various medical expenses. A drawback of the FSA, and this is something to keep in mind, especially when you're starting out, is that if you don't use the money in your FSA and your flexible spending account toward legitimate expenses, medical expenses, then that money is forfeit at the end of the year. You would have to give it, the company can take it back from you, or whoever you're working for. So onward. So investment decisions. Interest income from municipal bonds, for example, state or local, are not taxable and are not subject to federal income taxes. So if you have a bond, a debt instrument from a local government or the state of Michigan, for example, you don't have to pay taxes on the income that would be coming, the interest incoming income. You don't have to pay federal taxes on that. Tax-deferred investments include tax-deferred annuities, Section 529 savings plan, that's for children's educations, retirement plans, personal retirement plans such as IRAs, KEOs or 401ks. IRAs or individual retirement account. KEO plans are for small businesses, single person setting aside savings that way. 401k is, again, it's the same. It's a setup through your employer, if you will. So at any rate, so where are we at here? So we wanted to talk a touch more about on the so when we're talking about capital gains and profits from the sale of capital assets such as stock or real estate, there are two ways. If you have a stock, so we'll take a time out here for just a moment. So if you have ownership in a stock is ownership in a company. So I have one share of stock in Google, for example. So there are two ways in which you can make money on that stock, or that you can earn some income from that stock. One is through what are called dividends. Those would be payments made out like a profit sharing, if you will. And the other would be through capital gains. That means if the stock price increases over a period of time, and you sell the stock after that period of time, then you are going to realize an increase in that, in your capital gains, if you will. So self-employed individuals are able to deduct health and life insurance as business cost, and children, this is not exactly typical, but children with investment income of more than $2,100 are taxed at their parents' top rate. So this speaks to the marginal rate. So if the parents are in a tax bracket where they're paying 25% tax on their income at the highest marginal rate, then that investment income would be at that 25% as well. So onward. Retirement education plans. Traditional IRAs, they allow contributions of up to, I think it's maybe it's $6,500 a year. Now I forget, maybe 6,000. At any rate, today it's a regular IRA deduction is available only to people who do not participate in employed sponsored retirement plans, and adjusted income, gross income under a certain amount. In general, however, most people are eligible for setting aside IRAs, setting aside some money in their individual retirement accounts. There are two types of IRAs, generally speaking. One is the traditional IRA where it's pre-tax dollars, and the other is Roth IRA where you're using after-tax income to set aside in your Roth IRA. The difference between the two is that the traditional IRA is deferred income, meaning you're going to be setting that aside and you're going to be paying taxes on that at a later date so far as income is concerned. And the Roth IRA is after tax, and you will not be taxed on that income, if you will, after the age of 59 and a half. But the takeaway again is that 59 and a half is the key, is that you set this money aside in your IRA and you can't touch it until you are 59 and a half, until you are closer to retirement age, if you will. And if you do take it out prior to age 59 and a half, you'll be penalized to the tune of there's a 10% penalty on top of the taxes that you would owe in addition to that as well. So the other couple of plans, the Keogh plan is for self-employed individuals, and lastly, the 401k is set up through your employer. So there are savings plans through your employers, where you can set aside. Oftentimes, the employer matches to a certain point, if you will. All right, so just some general guidelines, if you will, when you're talking about personal tax strategies, involve the time and receipt of income, the payment of income taxes, payment of taxable expenses rather in relation to your current future tax rates, keeping track of these things. Take advantage of any tax credits for which you would qualify for, maximize contributions to tax deferred retirement programs, consider tax-exempt investments such as municipal bonds to protect you against which are not taxable in your federal taxes, defer capital gains and accelerate capital losses. Different tax strategies you would be employing. Take advantage of tax benefits of owning your own business. Always something to consider. There's a lot of risk that goes with that, but there are also tax benefits that would be associated with that. Plan purchases such as house or health care with the tax implications in mind. Not that the taxes drive everything, but it's something to always try to keep in mind as you're going forward. And finally, search out all possible itemized deductions, and keeping track of these deductions, if you will, is going forward. Onward we go with Chapter 5, Financial Services for Financial Planning. So in managing your daily money needs, it means such things as monitoring, your cash, checks, credit cards, cash machines, etc. No matter how carefully you manage your money, there are often times when you need more cash than you currently have available. That's just the nature of life, if you will. To cope with that situation, you have two basic choices. You can either uh, liquidate your savings, use the money that you have in the funds that you have in your savings account, or you can borrow. So different types of financial services include such things as again, divided up into four main categories. First, savings, pretty straightforward, involves uh, putting into a savings account, so on and so forth. Second would be um, payment services that give you the ability to transfer money to others for conducting business needs. Borrowing refers to credit alternatives available for short or long-term needs. Investments, of course, would be other financial services such as insurance, again, investment options, real estate purchases, tax assistance, and financial planning. So increasingly, what's happened is that there's been a move toward online or mobile banking. Online mobile banking would include such things as accessing your credit or your checking account, savings account online, or using different apps for your mobile banking and for making transactions, ATM machines, automatic teller machines, cash machines, whatever you want to call them. All this is part of that mobile or online banking, if you will. So onward, prepaid debit cards. Prepaid debit cards are very straightforward. They have become probably the fastest, they're fairly close to the fastest growing payment method for many consumers. And these cards are used instead of traditional banking services. Prepaid debit cards are issued by financial service such as Walmart, non-bank companies, and so on and so forth. So one of the major concerns with the prepaid debit card is that there can be extensive fees that are associated with using those debit cards. With credit cards, basically you pay later. With debit cards, you pay now. It takes money either directly from your checking savings, or it's again prepaid. But it's a pay-as-you-go type of a scenario rather than borrowing and then paying at a later date. So in general, when we talk about opportunity costs associated with financial services, is there's always a cost that's associated with these financial services. And the opportunity cost is what you give up when you're evaluating and selecting these financial services. Opportunity costs associated might include higher return with lower liquidity. So you're surrendering your liquidity for higher return. Higher cost for convenience, for example, for electronic banking or ATM fees and so on and so forth, or lost interest when we're talking about checking accounts and etc. along those lines. And again, we're talking about changing, fluctuating interest rates, consumer prices, and other factors influence the availability and the use of these financial services. So onward, we're now going into financial institutions themselves. They can be viewed in two major categories, at least for our purposes. Would be depositories, and the others would be the other financial institutions, the umbrella that would be out there. So depositories or deposit institutions would include commercial banks, savings and loan associations, mutual savings banks, and credit unions. And they serve the banking function by whatever name you want to assign to them. There are different reasons for the different institutions. So for example, commercial banks, again, They're the typical banker, Bank of America. Savings and Loans specializes in savings accounts and loans, mortgage lending. And but again, they've all moved well beyond their initial space in the marketplace, if you will, for financial services. Mutual savings banks are owned by the depositors and specialize in savings again and mortgage loans. Credit unions are something that's very typical, that most all of us are familiar, at least somewhat, with credit unions. They're very much like banks, but they're co-ops. They offer a wide range of services. They're owner, and they're nonprofit. Credit unions are nonprofit entities, if you will. Other financial institutions would be such things as life insurance companies, investment companies, mutual funds, so on and so forth. Brokerage firms are kind of outside of the realm of what we're actually talking about, but we'll get back to that in a moment. Finance companies, household finance, where we're borrowing, different borrowing companies that would be available out there. Credit card companies, again, are a little bit different, and mortgage companies as well. Brokerage firms are typically more what we call stockbrokers, and the difference between mortgage brokers and most of these other financial institutions is that they don't really take ownership of your. They're the ones that just they're responsible for making the transaction happen, and they don't ever take ownership of the assets, if you will, themselves. They are the ones that facilitate the deal. Okay, so when we're comparing again these financial institutions, going through the different functions, two basic things to keep in mind: depository institutions or deposit institutions. That's the typical banking arrangement that you would expect. The others, the financial institutions, are the ones that they're called financial intermediaries, again, for the most part, except for brokerage firms and credit card companies. But they're financial intermediaries in that they bring customers together, the lenders and borrowers together, if you will. Okay. So when we're talking about savings plans, so when we're looking at savings plans, the basis for your attainment of financial goals is the accumulation of funds. So you're building wealth. Remember, we talked before about income. Income is what you earn over a period of time. And what you do with your income, it goes to three places. It goes to consumption, your spending as a consumer. It goes to taxes, your portion that you're paying to the government for services rendered by the government, if you will. And lastly, whatever's left over, the residual, goes into saving. And so when we talk about income, that's over a period of time. And wealth is when you grow that savings. So you just keep adding more and more to that saving, hopefully, presumably. And so that increases your wealth. And that's what we talk about when we're speaking of savings. So again, the basis for your attainment of financial goals is the accumulation of those funds, of that income, of that residual income saving. It results in effective savings and investment programs going forward. So there are regular savings accounts, and of course, regular savings accounts we'll just go back to the depository or a bank, credit union, etc. You have your checking account, share draft account for a credit union, and you have your savings account. Savings account, typically the interest rate is a bit higher, and because the reason it's a bit higher, and even in very, very low interest rate times, there is some interest, and that is because you're actually surrendering that money, those funds, to whatever that institution is. It's theirs to use as they see fit, if you will. So that's the regular savings account. And so what you're doing is you're giving up your funds for a period of time in exchange for what? In exchange for some amount of interest income that would be associated with it. Certificates of deposit. So we're moving further and further away from cash money, if you will, or the checking account, first to regular savings, then certificates of deposits or CDs is a savings plan that requires you to leave a certain amount of that on deposit for a set period of time, 30, 60, 90, or 90 days, and so on out. It can typically up to about a year and a half. The main types of CDs are include rising rate or bump CDs, where you have higher interest rates at various intervals, such as every 6 months. However, this rate may be in effect only for the last few months of an 18 or 24-month CD, for example. Liquid CDs offer an opportunity to withdraw without penalty. Likely requires a minimum balance on the account, and on top of all that, it would be at a lower rate of interest. So a zero coupon CD is purchased at a deep discount with no interest payments. So, for example, you might buy a zero coupon CD or zero coupon bond, if you will, for $5,000, and you keep it till its maturity date in, say, 10 years time, and it would double from $5,000 to $10,000. Index CDs have earnings based on stock market. In times of strong stock performance, your earnings could be higher than those of other CDs. So there are all kinds of different types of CDs. Callable, non-callable CDs. Callable CDs start with higher rates and usually have long maturities, as high as 10 to 15 years. With this saving option, if interest rates drop, the bank may call or close the account after a set period of time, such as 1 or 2 years. So they have the option, if you will, the bank, whatnot, to call the loan or to pay off to pay off that CD, to give you your money back, in essence, right? So consider creating, and again, this is different ways of going about doing this, where you can do it over a period of time and so on and so forth. So there's a degree of liquidity and flexibility in investing your funds. So the other piece that we're looking at, moving away from CDs, would be money market accounts and funds. And money market is a savings account that requires a minimum balance, and earnings on money markets usually allow savers to write a limited number of checks or make large payments or transfer money to other accounts, but these are very limited. These money market accounts are also covered by Federal Deposit Insurance Corporation, or the credit unions with the NCUA. It's not really truly a money market fund, which are products of investment companies. So onward we go. Savings bonds, U.S. savings bonds, EE bonds are purchased for any amount greater than $25. Electronic EE bonds are purchased online at face value. For example, you pay $50 for a $50 bond. Paper series are no longer available. The EE bonds increase in value as interest accrues, so it's just added on to that $50. The main advantage of the EE bonds are interest rates exempt from state and local taxes, and federal income tax on earnings is not due until the bonds are redeemed. So you don't have to pay as you go. You don't have to, the interest is not taxable until you actually redeem the bond. The HH or the HH bonds are no longer sold, where current income bonds, etc., were interest deposited every 6 months. The I bond earns a combined rate consisting of a fixed rate for the life of the bond and an inflation. So these are I bonds. They're also called index bonds, if you will. The rate changes every 6 months, and the new rate is established again based on the current annual interest rate, inflation rate. They're sold in the same denominations, if you will, as the EE bonds, but are purchased at face value, not at a discount. And so when we're evaluating these savings plans, we're looking at the rate of return. The rate of return, or yield, is the percent of increase in the value of your savings due to the earned interest rate. Compounding refers to interest that is earned on previously earned interest. So you earn 10% interest on $100, that gets you $110. for 1 year, for example. So you take the $100 and tack on the 110, and then for the next year you get another 10% interest, and that would be $11. It would be tacked on to the $110, so getting you $221 after 2 years. This is compounding, adding to this, and you get interest on that principal and the new interest. In 1993, the truth in savings from the Federal Reserve, it's called the Federal Reserve Regulation DD or double D, became effective. This law requires that financial institutions, it's a full disclosure really is what it is. They want you, so that you know what, if there are any fees on the deposit accounts, the interest rates, the annual percentage yield, or APY, and we'll get into that in a moment, but other terms and conditions of the savings plan. So the truth in savings defines annual APY or annual percentage yield as the percentage rate expressed in the total amount of interest that would be received on a, for example, $100 deposit based on annual rate and frequency of compounding for a 365-day period. So the rate of your return you earn on savings should be compared with the inflation rate to start with. Also, keep that in mind. In general, as the inflation rate increases, the interest rates offered to savers also increases. This gives you an opportunity to select a savings option that will minimize the erosion of your dollars on deposit. So further tax considerations. So inflation is something to always be wary of or be aware of. Taxes reduce your earnings on savings. For example, if you're 6.25% return for a saver in a 28% tax bracket, means a real rate of return of only 4.5% because of that 28% tax erosion of your return, if you will, impact on your return. Liquidity, again, allows you to withdraw your money on a very, very short term, with a short term notice. So most savings, most depositories are affiliated with the federal government so it's covered by the FDIC or the Federal Deposit Insurance Corporation. And what that means is that your savings are covered, if you will, up to $250,000 per person per financial institution. Okay, so this is the FDIC, and there's also the NCUA on the credit union side, and they're all pretty close to the same. So that addresses the safety side of this, if you will. So onward we go into consumer credit. So when we're talking about credit period, we're really looking at it's the arrangements associated with receiving cash or goods or services now and paying for them in the future. So it's all about consumption, consuming now and paying later, if you will, for those goods in which you're receiving, that you're consuming. So consumer credit has to do with all of those needs, all of that credit that would be associated with the individuals or families, and covers pretty much everything except for mortgages, if you will. Mortgages are usually kind of held back from that. So when we talk about the importance of credit, it's something that it can be good, it can be bad. It's in some cases it's neither. It's neither good nor bad. It's just a fact, and that is that if you it's essential in terms of there's a term that I bring up, I've used before, it's called the life cycle hypothesis, and that is that when you're young, that is when your expenditures often exceed your income, and for reasons that are fairly rational or very rational. If you want to, if you need to have a car and you don't have the cash for it, you need it for work, for example, then you buy that car on credit. Very typical. People don't go out and buy homes for cash typically. Typically, in most all circumstances, there are mortgages on homes. And this is what drives the economy, why it's so important for the economy. Credit is what's, you got two sides of this exchange. One is that the person that's borrowing, and they're trying to again consume more than they would otherwise be able to, and the other side is lending for what? Opportunity cost, for interest, for the time value of money, being separated from your money, etc. Anyway, and so jumping immediately from the importance of that credit into uses and misuses of that credit, there are valid reasons again for using credit, ranging anywhere from medical expenses, emergencies, to need for a car, so on and so forth. And if you don't have the cash up front to pay for these things, then you have got no other choice but to go out and borrow if at all possible. So these are all decisions that are made, and this is the advantageous side to credit, if you will. It enables you to consume, to buy things that you would not otherwise be able to buy for good, valid reasons. And in finance, there's a simple rule, or one of the many rules, but it's one I always try to point out at the very least, and that is that if the cash flow from your borrowing results in something positive, so if there's a positive cash flow, then that's a go in terms of getting the credit and going that route. So this is kind of a metric of, if you will. So there are also misuses that are associated with credit as well, always. And misuse credit can result in default, bankruptcy, loss of reputation. And so there are lots and lots of downside risks that are associated with credit as well. So anyhow, moving on to the types of credit, there are two basic types of consumer credit that we were talking about. And one would be closed-end credit, the other one open-end. Closed-end has to do with something over a very specific period of time, installment payments, and so on and so forth. Think about like automobile loans. It's set over whatever, 24, 36, 48 months, 4 years, 60 months, etc. So that's that defined closed-end credit relationship. The other is an open-ended credit, and that would be such things as for credit cards, right? Credit cards, there's a whole laundry list of included credit cards, smart cards, debit cards, store value gift cards, travel entertainment cards. Smartphones are often, again, if it's the app set up. Home equity loans are also open-ended credit where you're actually borrowing against the value of your home. And also the last thing, protecting yourself against debit credit card fraud. These are all things that have to be taken into account as you're moving forward with this whole credit relationship. So when we're talking about measuring your credit capacity, it's pretty straightforward. Can you afford the loan? And so the focus on that is that before you take a loan, you have to ask yourself whether or not you can meet all the expenses and your monthly payments, et cetera, that are associated with that. So there are general rules of credit capacity that point out in the book, and included would be such things as debt payments to income ratio, where you calculate your monthly debt payments by your net monthly income, after tax income, and you set aside your house payment, your rent or your mortgage payment, and after that. So it's the rule of thumb, or the expert guidance says that that ratio, your debt should be no more than 20% of your total net after tax income. Debt to equity ratio is calculated by dividing the total liabilities by your net worth. So again, don't include your home. If your debt to equity ratio is above 1, you probably reached the upper limit of your debt obligations. So in other words, you can't afford any more. You shouldn't be that far in the first place. So co-signing loans, co-signing a loan, this is something you would encounter if you were either typically with parents and children, where children want to buy something and they don't have the credit availability. They don't have a good credit record. So a parent might co-sign with them, and or sibling, something along those lines, parent, grandparent, etc. And what that means is that the co-signer agrees to pay in the event that the principal borrower, if you will, is unable to meet that obligation or does not meet the obligation. So onward. So when we're talking about credit again, we're looking at building your credit scores and building and maintaining your credit rating. We hear the term credit rating all the time. Basically, what a credit rating is that it's established through credit bureaus and through such things as Experian and Equifax. There's another one that's out there. I forget, the name escapes me at the moment, but they track your credit history. So always, so it's important for you to build and maintain that credit rating. Building the credit rating means to go borrow, and to borrow responsibly, and to pay off your debts in a timely manner, and so on and so forth, right? So again, the credit bureaus there are several hundreds, if not thousands, of credit bureaus around the country, and they produce reports and present on your, they have reports available on your past and your present credit activities and so on and so forth. And so the question is, I guess, who provides that data? The credit bureaus, and it's very straightforward. It would be the merchants from whom you are buying things and have credit going forward from that. So what is in your credit file itself? It contains very specifically your name, address, social security number, date of birth, and your payment histories, your credit histories, if you will. The other question is, and I'm sure we've all seen ads for it, and obtaining your credit reports, and we can get our credit reports, and typically you're able to get, I think, one free credit report per year. I think that's the requirement at this point, and it can only be issued to you or to creditors with whom you give access to your credit report, so that you can establish credit with new borrowers, if you will, or new lenders rather. Okay. So where are we at? There are, so again, it's very straightforward. There are time limits on adverse data that are out there on your credit reports. Your data, if there's some problems with your credit file that you don't agree with, you can contest those, and there are various remedies: contacting the credit bureau yourself, and always contact the merchant as well, whoever that might be. So when we're looking at applying for credit, if you will, so what creditors look for is straightforward. It's something that is, in marketing, there are the 4 Ps or whatever, the price, promotion, etc. In credit, they're called the 5 Cs of credit. And the 5 Cs of credit include, character, capacity, capital, collateral, and conditions. Character, your own character, whether or not you're paying your bills on time, so on and so forth, or you have a track record of that. Capacity, are your outstanding debts, are they are they reasonable, the amount, so far as your income and so on and so forth, as we've already talked about. Capital, if you have the if you have the financial means for which to pay for your the income associated with it, pay for this credit that you're seeking, collateral, something that you can have against that. So if you're borrowing home equity line of credit, you have to have a home in order to that would be the collateral that would be associated with that. And economic conditions are the last thing, and that's something that's constantly changing, whether or not your job is safe going forward, and so on and so forth. All these things are taken into consideration, right? So what there we have here, we have different ways of, again, looking at what creditors are looking for. Again, the 5 C's that we just mentioned. Your age, are you on public assistance, do you have any outstanding housing loans, meaning your mortgage, etc., and what are your FICO and Vantage scores, specifically your FICO. FICO is a credit score that's set up so that you can see how you stack up. It goes anywhere from, I think it's 350 up to 850, your credit score. And so the higher the score that you have, the better off that you are. And there are also, if your application is denied, there is some recourse. There are things that you can do in the event that your application is denied. They have to give you the reasons. For example, a creditor they have to give you a reason why it is that you were denied that credit, and you could go about fixing that credit. Or if there is a problem, you can fix the error. You can remedy it that way. Okay, so if we're looking at actually applying for credit, we've already talked about this. So last thing we're looking at is avoiding and correcting credit mistakes. And again, this is very straightforward. The last couple of things. This is the recourse. These are the options that you have in trying to correct the errors that are out there. In case of a billing error, you've got time in order to dispute that billing error. Meaning that if you have a credit card that you have something in dispute with the merchant, contact two things. You contact the merchant. You also contact your credit card company, and your credit card company will also pursue with that merchant to try to rectify the problem. And you've got two cycles, 2 months, we'll say, for it to be to either be fixed, or if it's declined, then you are on the hook for paying that bill, if you will. And there are different things. One of the beauties of a credit card is that it's much easier to return defective goods or services because you have the backing of that credit card company. So if you had paid cash for something, sometimes it's tougher to get your money back than it would be through a credit card. So oftentimes it's advisable to use credit cards for purchases. It all depends, but it's something that it's an added benefit, if you will. And so far as your identity theft is concerned, these are always things to watch out for. This is why you look at your credit. You be sure that you review your billing statements from your credit card. Review your banking statements. For debits and use of your debit card for your checking account and so on and so forth. So you should review these on a regular basis to make sure that there are not some fraudulent charges, if you will, and these are things you constantly are staying on top of. So lastly, very quickly, when we talk about complaining about consumer credit, complaints about banks, there are lots of options, lots of availability, different protections under consumer credit laws, as I said before, the Truth in Lending, Consumer Leasing Acts, the ECOA or the Equal Credit Opportunity Act, the Fair Credit Billing Act, Fair Credit Reporting Act, Consumer Reporting Reform Act, Credit Card Accountability, Responsibility, and Disclosure Act of 2009. And these are all things that are available, and whether we're looking at the federal level or if we're looking at the state level, there are many, many avenues for you to pursue in the event that there is some problem with there's quite a bit of consumer credit protections out there that are available to you.